This is what scares the pants off you all, right? And I've put this graph deliberately to do it. Investing is volatile. Those are those three indices that I just mentioned. This is cash. It's always going up, not by very much, but you're absolutely sure it's always going to go up. Your interest, you're getting interest above. But with these trackers, look, they're up and they're down. It's a roller coaster, up and down and up and down. And what you're all worried about is, what if I buy here and I sell here? Yeah, that's the risk. That's the concern. And you're right. And the first worst thing to do as a beginner investor is to be checking your share price every day, because it will do that and you will hate it and you'll think, oh, I can't cope with this. You're investing for a long period. Hopefully you've made the right decision and you have to look at it over the long period. And it has to be with money that you're not going to need to escape, because the last thing you want is to be forced to sell here because you need that money for, you know, the window that's been smashed in your kitchen. That's not what the money you put in investing, which is why the golden rule here is this. Only invest what you won't need for at least 5 years. You said 3, I say 5, some say 10. After clearing your expensive debts and you've got a savings emergency fund of 3 to 6 months worth of bills, that's the money you're investing. If you haven't got that, you're not ready and in a position to invest yet, I would say. Some would say go for it because you might win, but I'm more risk averse than that. So that's the key point. That's what we're worried about if you don't do it for a long time. But here's the magic. That's when you're looking just at the moves up and down on an annual % of return. Now let's look at what happened to those same funds when you factor that all in over a 10-year period. First, before we do that, I'll show you what happened. Here it goes. Top savings. Now, these are my top savings picks that I've calculated, even the very best on the market. If you're playing the whole Martin Lewis system of top easy access, if you put £1,000 in 10 years ago, because we had all these years during the pandemic of everything of less than 1% interest rates, you would have £1,270 now. But inflation, you'd need £1,390 in not to have lost money in real purchasing power. Do you understand what I mean by that? But lost money to inflation. So that's top savings. In reality, it was losings over the last 10 years. It's been better in the last couple of years, but in reality, it was losings. Now let me put those 3 index funds on there. OK? The FTSE would be 1,640 from your £1,000, beating inflation. The global tracker, 2,980. The S&P American, 3,790 times, nearly 4 times what you started. Now, I should say, these are funds where you reinvested those dividends we talked about, so you got that compound investment growth, a bit like you got the compound interest on savings. Now, look, this is long-term historical data, but I've got to tell you, got the regulator sitting over there, the big boss of the regulator, I've got to tell you, past performance doesn't guarantee the future. But on the balance of probabilities over a longer period, investment will win.